Welcome to the Real Estate Finder podcast. I'm Matthew Mashler, real estate broker with Signature Real Estate Finder here in the great state of Florida. And with me, the co-host of the Real Estate Finder podcast, Stacey Garcia. Hi, Stacey.
Hi, Matthew. How you doing?
I'm very good, very good. And also, we have my real estate partner of 45 years, Jill Glanzer.
Hi, everybody. Excited to be here.
She's been doing real estate since she was a baby. And we have a very special guest in the studio today. We have Jessica Green from, what's the name of your business?
Green Tax and Business Advisors.
Green Tax and Business Advisors. That's your website also, right? Green Tax and Business Advisors?
Yes.
Awesome. So met Jessica recently, and we started talking about tax. It's one of the subjects I like talking about. It's kind of weird. I like talking about
Taxes,
Las Vegas, wrestling, college search. Weird stuff. So we invited Jessica to come in onto the podcast and talk about taxes, because we've done over 100 episodes of the Real Estate Finder podcast, and the subject of taxes hasn't really come up that often.
I do have a lot of questions about it. I just never had anyone to ask.
Right.
Even recently, I was just asked about capital gains.
Uh-huh.
And I was like, I don't know anything about that.
Do you know anything about capital gains?
I know a little bit about capital gains.
Yeah. Okay.
So should I ask a question, or you want to tell us about your business?
I can tell you a little bit about myself.
Yes, please.
You can ask a question. I primarily work with real estate investors, property managers, construction companies, and I also work with professional services doing tax strategy and planning and full service accounting. So,
interesting.
You do like tax returns?
We do tax returns. We do bookkeeping, accounting, and a lot of what I do is tax strategy.
Mm-hmm.
Strategy.
All right. And it's actually very timely, right? Here we are. It's the end of February. I'm sure is it already your busy season, or are we getting into it?
It's really busy because March 15th, you have partnerships and 1120S tax returns due soon, subchapter S's. So we're just gearing up for that.
We're gearing up for that. Yeah, March 15th is coming up. I always thought it was April 15th.
April 15th is for your personal tax return.
Oh.
We just learned something new.
There we go. Uh-huh. And I guess they have to do those partnerships on March 15th, so that way someone has the information so that they can file on April 15th.
Right. So let's say you're part of a syndication, or you have multiple partners and you own real estate, or you're buying and selling real estate, you can do a partnership or S corporation, and then you get a K-1. That K-1 gets put onto your personal tax return. So you can be a passive, or you can be actively participating in the business.
Gotcha.
That's for ordinary gains.
Are you an accountant?
I'm a tax accountant.
You're a tax accountant.
Yes.
Is that a type of accountant?
Yeah, I focus mostly on tax strategy, and I also have a wide range of people on my team who range from EAs, CPAs, other bookkeepers, other tax preps.
Okay.
And I'm the owner of my business.
And you own the business.
Yeah.
And you're relatively new to South Florida?
Yes, I've been in Florida for a year and a half. I bought 2 years ago, but I moved here a year and a half ago.
All right. Where did you move from?
I moved from Dallas, Texas, and great place, but we're really happy to be here in Florida and South Florida.
That's awesome. What made you move to South Florida? Was it the taxes?
There's no state taxes in Texas, no state taxes in Florida.
Okay, so that was a wash.
Yeah, wash. I moved here to be closer to my parents. I have young kids, so they get to be raised with the grandparents.
That's cool.
Nice.
That's nice.
I have my own house. They have their own house, but we're 6 doors down.
Oh, that's awesome.
So they open the door and run to their house.
That's amazing.
Adorable.
That's a luxury.
Yeah.
Twice I lived in the same neighborhood. Twice while married to my wife, Wendy, I lived in the same relative neighborhood to my father. And she always insisted it wasn't the exact same neighborhood. So we could not do that.
Right. A little too close.
She likes that we live in a gated community. So when they come through the gate, she gets a 2-minute heads up.
Yeah, my stepfather is actually a public accountant also.
Oh, yeah?
So we get to discuss some of the new tax law and argue between the both of us. Well, I interpret it this way, you interpret it that way, and because you can look at something and interpret it 5 different ways. So it's always great to have somebody who has over 30 years, let's call it 50 years of accounting and tax experience.
If I have my first, it wasn't my first job, but my first professional job, I was an attorney like a millennium ago. like in the 90s. But and I went out and I bought a suit. Is that a business expense?
No.
No. And because I heard you talking about arguing and debating it.
So if you are like, let's say, a construction worker and you need to get just steel toe shoes, that's a business write-off because you have to wear a particular type of shoe. Or if you're a nurse and you get paid a 1099, not a W-2, you have to buy your uniform, that would be a deduction.
1099 is an employee?
A 1099 is a general contractor.
1099 is a general contractor. W-2 is an employee.
W-2 is an employee.
So if
People
you're
get that confused a lot.
So if you're a nurse employee, you cannot write off the scrubs, et cetera. But if you're a nurse general contractor, independent contractor, you can.
Yes, but that's because nursing has a specific uniform that you have to wear. I tell people that if you're a real estate agent, you have your own LLC and you get clothes, like what I'm wearing today, I have my logo on it, then I can expense that as promotional goods.
So a polo shirt with a real estate company logo.
Your own business logo.
And all my realtors are independent contractors, so there's no issue there.
So if you're a real estate agent, so your team, if they wear your logo and you pay for it, then that's promotional.
It's a business expense to me.
Right.
Gotcha.
Not to them.
Not to them.
But if they buy the shirts directly from you, maybe.
Yes.
Yeah.
But if they go out and order shirts
Right.
with the company logo on it, it's a business expense to them.
This is actually really funny because years ago I was working a regular job and I went to an accountant and he's like, "Oh, I can write off uniforms." I'm like, "I don't wear a uniform." I never did. I never let him do it, but I thought it was really funny because it brought that up.
Right. So if you're an esthetician and you have to wear a uniform and you make everybody wear the same uniform, then you can write that off.
See, when I was in school, I had long hair, like past my shoulders. And after I graduated law school and I went to go get a job, I cut my hair. And then I kept it short. So I always thought that like my haircut should be a business expense because if I was not working this job, I'd grow it long. But no, it does not pass the...
Getting your hair, nails is not a deduction.
Not a deduction.
That's called grooming.
Yeah. And also...
Grooming is bad. We can't do that anymore.
Right.
So, all right. So a lawyer buying a suit, not a tax deduction. If the suit has a logo on it...
Your business's logo on it.
Business
then it's
logo. Okay. A professional wrestler buying ring gear, that probably would be...
That's his business, so he needs supplies.
That's a business supply.
Yep.
Okay. So...
but if you're not wrestling and you buy gloves,
You would-
clothes, it's
Not
not a write-off.
right.
But if you're buying a singlet or a leather cloak for your wrestling costume...
If it's for the costume and
Yeah.
you're wearing it for that, not normally wearing it for yourself personally, probably yes, it is.
All right. The problem is when we have our wrestling shows, my gear is I wear a suit. So I bought a suit for the wrestling show, but it's still going to be considered a suit. It's not going to be considered ring gear.
You're not the wrestler.
No, I am now. Well, I'm a promoter. I'm in the ring with the microphone and everything. I promote my own shows. Yeah, we just met each other. Our next show is March 17th at B'nai Israel on Yamato Road.
Oh,
Yeah. You go to B'nai Israel? Your kids are there?
I go to B'nai Torah.
B'nai Torah?
Yeah.
I met you at B'nai Israel, though.
JCC.
Met you at JCC?
Yeah.
I always get everything confused. I call it SJC, some Jewish charity.
All
You
the
talked
Jewish
to me
stuff.
for 30 minutes on the B'nai Israel. And I were talking about B'nai Israel.
About B'nai Israel.
That's why
Not
I
at
got
B'nai
confused. Yeah.
Right.
Okay. That's my wrestling card.
But your suit is not.
Right.
But if you
it's
put something on your suit that it was branded, then it would be.
Yeah.
Right. It has to be more of a costume.
The handkerchief that you have here, brand it. Brands it right off.
There we go.
Or if it's like a glittery suit that you would only wear as a ring announcer, I think that
Like
would
Ric
count.
Flair.
Mm-hmm. Well, he has those robes.
Yeah, but you could Ric Flair this thing.
Yeah.
You could Ric Flair it out.
By the way, if anybody out there makes ring gear, we're actively looking for some new sources. So anyway, all right. So we were on a tangent from you and your stepfather arguing about what is or what is not tax deductible.
Yes.
That's how we got onto this part of the conversation.
So I think it's fascinating.
Usually it's like an influencer. Is the nails a deduction or not a deduction?
Right, like if you're filming the manicure and TikToking about and reviewing different nail salons?
That would be a write-off because you're an influencer.
Mm-hmm.
But if you're a real estate agent, you get your nails done, that's not a write-off.
Even though you're preparing for the showing?
Even if you're preparing for the showing.
Mm-hmm. If you're an influencer, but you're really, really bad at it and don't make any money on it, can you take the write-off against other sources of income?
Well, if you're not making any money, then it's not really a business, is it?
Well, you're trying. I mean, it takes a while to grow an audience.
Well, the IRS looks at a hobby if you've done it for 3 years and haven't made any money on it.
Yeah.
Oh, ouch. So that would be my Twitter.
But you also do podcasts.
Yeah. But I've been on Twitter for like what? Since 2009, haven't made any money at it.
But you don't make any money on it, right?
Not an influencer.
Yeah. Ouch. Okay.
Yeah. Well, I've been working on my TikTok for 3 years and I have about 17 subscribers. Really, really bad influencer.
And if I have a hobby and I'm losing money, I can't write that off.
So there goes your drumming.
Well, you can have a hobby and you can try to make money, but like usually after 3 years, the IRS is like,
Okay, it's a hobby.
If you lose money every year for 3 years, the IRS is going to say it's a hobby. So I'm going to have some problems at the wrestling show.
yeah.
We haven't made any money.
You're in
yet.
a time crunch now.
We haven't. We're coming on year 2.
So exciting.
So have you found it hard transitioning from Dallas to Boca in your business, or because neither state has a state income tax? Is it pretty?
We can handle any of the 50 states, and I have clients that work all over the country. I had a big network in Dallas, but I still get a lot of referrals, so it's fine working here in Florida. And I like the Jewish Federation. They have really great programs there, so I network there.
Do you come to the Business and Professional Breakfast series?
Yes.
Yeah. That was another.
That's where we met.
That's where we met.
That's it.
It wasn't JCC. Oh, it wasn't JCC.
No, it was
Federation, the BNP. I chair those breakfast series. Can't go to the next one. It's during WrestleMania.
That's a holiday.
So, it is a holiday.
A high holiday.
Yeah. So, okay. So what does, do you have real estate agents as customers?
Yes.
All right. What would you tell a real estate agent who is thinking about hiring you?
Well, there's things that come up when you're a real estate agent that you think that you can claim as a deduction. Usually they don't save enough money for taxes.
Right.
And they just think like, well, I haven't really made any money throughout the year. And then I sold a couple of houses. So I kind of work with them on how much money you should put each quarter. And so the fact that I'm approachable, they quite like that. I always tell my clients, please, hello? Oh, okay.
Yep, we're here.
I somehow disappeared. I usually talk to my clients. I tell them, please contact me. Do I buy a car? Do I put it in my personal name? Do I put it into the business name? I usually say put it in the business name, even if you have to pay more in title and monthly fees, because you can depreciate the car in the business. You get a bigger deduction. But a lot of the times they put it in their personal name, so you can't. So it's hard to depreciate the car.
If you put it in your personal name, can you just put it on your books as if it's a business expense?
Normally, the best, if you're a Schedule C and you have an LLC, it's better to have the car in the business name. If you have it in your personal name, you can still claim some miles, but you wouldn't be able to claim 100% because you are using that car for personal. And we like to use Mile IQ to track your miles. Usually 9 out of 10 times. You're a real estate agent. You're driving everywhere. Keep track of your miles. Right. Because that's going to be your biggest expense. I believe QuickBooks, you can keep track of your miles, and you can also keep track of your receipts. But always keep track of your miles. And notebooks do get lost. Right.
And when you say to keep track of your receipts, you fill up the tank with gas. That's why you're tracking the miles, because you're trying to figure out, all right, I put 20,000 miles on my car. 12,000 of those miles were for business, so that the expense of the car, the expense of the gas, et cetera, would be proportional.
You cannot take gas and miles. You can only take one or the other.
Right. Well, right. The mileage includes the gas, the wear and tear in the car, the brakes, the tires, etc.
Yeah, the miles is normally, I believe it's 65 cents the mile.
You could take the payments, the car payments, and the miles.
Not if it's not in the business name. You can't take the car payments.
All right, so it has to be in the business name to
And
take the car payments.
you can take the interest of the car,
Uh-huh.
not the actual car payments.
Gotcha.
There's a lot to know as an accountant, and I'm glad I'm not one.
Yeah.
It's a lot of information, right?
It is just like real estate is. You just don't realize it.
Well, when
you
I
do
went
it.
to University of Maryland, I was pre-accounting freshman year.
Oh, wow.
Yeah, but the building was too far away from my second year location, so I changed it.
There was an agent last year that sold like a $4 million house, got a $120,000 commission.
Right.
And then you start thinking, okay, he's going to have a big tax bill if he doesn't think about that or plan for that.
Right.
Like that's going to be an issue. That's why he's going to have to start thinking about his mileage and his other business expenses, because there's a big expense, and you know, at Signature, the real estate broker, we don't withhold for taxes. Right? Employers withhold for taxes, but you get your real estate commission. That's a check, and
You spend it.
right? So
The miles is actually 65.5 cents in 2023. 2024 is 67 cents to the mile. And when you get a big check from selling a house, I say put 20% away.
20%.
And if you are making, let's say, over $200,000 a year, 30% just to be safe. And if you can, try to pay the IRS quarterly.
Go on a quarterly schedule, so that way.
That way you're paying your taxes throughout the year and you're not hit with a $40,000 IRS bill.
And you're not tempted to spend it.
Yeah.
Yeah.
Yeah. You can keep the money if you want in a high savings account accruing 1%.
Yeah, interest rates are up. You can find 3 or 4% nowadays.
Depending which bank, yeah.
Yeah, you gotta look for it. So, but that's a really good piece of advice. So you also said real estate investors.
Yes.
Right? What does a real estate investor have to know different than a real estate agent?
Well, real estate agents help other people buy and sell properties. So sometimes the real estate investor does it for themselves, and maybe they have a full-time job, and then they try to say, well, I'm a professional real estate. And I'm like, no, you're not, because you have a full-time job and you're making a lot of money. So how are you going to prove it? And if you typically, if you don't have a full-time job and you're just doing real estate investing, that could be buying and selling, buying and holding. Airbnb is a big one that I get. I always get questions like, if I'm doing Airbnb, is this considered like a rental, or is it considered a business? And I usually put it as a business so that you can claim the income and losses against your W-2. But if you're a real estate,
if you classify it as a business, the business expenses they don't have to match the income from that business. It can match the income from other businesses.
it can match your income from your W-2. So if you make a massive loss, probably due to depreciation, it will offset your W-2 income.
Gotcha.
And if you earn under $140,000 and you earn property, you can also claim the losses on your tax return.
Gotcha.
And that's how people pay zero taxes. It's a way to help people pay zero taxes. Right. And that's why a lot of people want to become real estate investors. You have to spend, usually you have to spend around 750 hours, but you have to spend quite a lot of hours and maybe become a broker just to become a real estate investor.
So that way the IRS considers that your job.
Main job. Yeah. So if you're have a full-time job making $500,000 a year, it's going to be really hard to say, okay, you're also a real estate investor, because then what are you doing in your day job? There's a lot of hours and time that you actually have to spend. You have to prove it.
So if you have a day job and on the side you do some real estate investing, what is the difference between doing in the taxes on that versus if you are a full-time real estate investor? What changes?
So if you're doing, like, if you have some properties, but it's just maybe you inherited it, or you're just trying to build some wealth in a different way and your own property, If you make income, then you pay the taxes on it. If you make a loss, it gets carried forward till you start to make a profit. So you can't deduct those losses on your tax return.
I see.
Because you're not really a real estate. You have real estate, but that you're not a real estate professional.
So I know plenty of people that have a day job, but then they have maybe 1 or 2 or 3 rental properties or an Airbnb, or maybe up in the Disney area, they have those vacation rentals that they put in the hotel pool. So they're not professional real estate investors, so that they have the income that they have to be taxed on, or if there's a loss, they can't match that loss to other businesses that they have. They have to carry it forward.
So if it's real estate or passive income and one property makes a huge profit and the other 2 properties don't make any money, then that profit offsets the businesses, the other real estate that hasn't made any money or a lot of money. And so let's say in total you made a loss, then that gets carried forward. But if you made money, then you pay taxes on it. Gotcha.
And what's important to note here is all of these situations are unique, right? Each person's individual business and their investments, will get different advice. And that's why you need an advisor to figure out what it is that you're doing and how do you structure it better so that way you can minimize your losses or maximize your deductions.
Right. And a lot of times I see real estate agents give their clients $500 towards something, or and the gift tax rule is $25. So anything more than $25 is really not a deduction on your tax return. You're only technically supposed to do $25. So you can go to a store, like a fancy store, and buy a bunch of gift certificates that are $25.
So if I got you a $100 gift card, I'm not going to, but if I got you a $100 gift card and said, thank you for joining me on the podcast today, there's some kind of tax involved?
You're only allowed to claim $25 of that $100 as a business write-off.
I can only claim, so that $100 is not a business expense. I can only claim $25 as a business expense.
Right, so you would give me a $25 gift card.
I'd have to
4 of them?
Or you can get 4 of them.
Right.
The IRS is not going to track.
Right. That's what I was going to ask.
How many times? Not necessarily going to track if you gave somebody 1 card or 5 cards, but they can track that $100.
Oh, interesting. I was going to ask you, how often can you do the $25? Is it every day or once a year?
The gifts is just increments of $25.
Increments of $25. So I did a deal recently with Texas Roadhouse where I bought $2,000 worth of gift cards, and they put a billboard, an ad in the Texas Roadhouse with my name and picture and phone number, website. So I thought it was a great deal because I got back the $2,000 worth of gift cards. So it was almost like it was free for the billboard, except that not really free. I'm now restricted. I have to use this money at Texas Roadhouse. I did it in 2 different Texas Roadhouses. So in one Texas Roadhouse, I asked them for they gave me the gift cards in increments of $25, and I got a big stack of them. And I thought to myself, well, that's as a gift, that's not going to be enough to buy like dinner for 2. I'd rather a $50 gift card. So the second time I did it, I got a $50 gift card because I thought that would be a better gift to pay for someone's full meal, assuming they're not eating alone at Texas Roadhouse. The charge on my credit card is the same.
Your example is not a great example because it's advertising. You're really advertising with them, and then they're giving you back the gift cards, so you can use it. You can use the gift cards to re-gift it, like as a promotion, or if you take people out, you can use the $50 and get the meal deduction.
I was just trying to think.
But it's more like if you sold a house to somebody and you bought them a $600 chandelier.
Then
it's really, the gift for the client is really $25 that you can write off.
So if I gave a closing gift to a client, that's not a business expense. Because if it's over $25, it's not technically a business expense.
The rest of it is not really a business expense. But that's why there's all different types of closing gifts. But if you put your logo on it.
And then these gift cards had my logo on it.
Yeah. So if you buy a gift basket and you buy 10, fill it up, and you buy a bulk of it, and then you put your card in there, you can have that as you can write off the things that you bought in there.
That's a good idea.
That's marketing. What about if I, let's say I represent the buyer and there's, a $5,000 commission, and I rebate my customer $500 of that commission.
That's just the sale of the house. It's not a gift.
It's not a gift to them. Yeah.
Because kind of having that contract that.
Well, if it's not contract based, if I do it out of the goodness of my heart, I just credit them $500 at the closing table. And I say, it was a pleasure doing business with you. Maybe.
It's not a gift.
It's not a gift. You know what I always wondered about?
We had that situation where we bought and from the agent sold the house. Mm-hmm. So they gave us back like $3,000.
Mm-hmm. Not a gift.
But you're allowed to give people $14,500 and not claim it on the tax return.
Right. Oh, see, I see. Because I never received the money, so I don't need a deduction. Right.
Right. It's not a deduction for you.
Right. That's in my example.
Because you got the money, but then you
No, my example, I didn't. And the reason there's no tax is I never received the money. I was supposed to get $5,000.
Yeah.
I didn't get $5,000. Now I only got $4,500.
And so $500
went to the buyer. So it was. I think it was a gift, but there was no deduction because I didn't receive $5,000. I only received $4,500. If I receive the $500, then I deduct the $500, and then I give the $500. That's why it's not a gift there. I see that. I'm going to ask you a question. This is something I thought of for a while. I never asked anyone.
Yep.
Okay. Sometimes I buy properties for myself. Right? I'm an investor. I saw the one we listed this week. It's a property that I bought for myself. So at the closing, I said, instead of taking the real estate commission, let's say it was a $500,000 house, so it would have been a $15,000 buyer's commission. So instead of taking that $15,000 as income, I had it credited on the closing statement, and I paid $15,000 less for the house than I would have, even though the price of the house on the closing statement says the same thing. It says $500,000 house, so I carried on my books for $500,000. There's $15,000 that I didn't pay. That's not income. Is that $15,000? So if I would have taken that as income as a commission,
but you sold the house at $500,000.
I sold the $500,000.
That's what it says in title.
I sold the $500,000 house to me. I didn't take the $15,000 as income. I had it credited to the purchase price.
So it's just part of the down payment.
I would have paid $15,000 less, even though it's on my books as $500,000. I just didn't pay the $15,000. I didn't pay $15,000 of it, so I didn't take that $15,000 as income.
You're just moving money from one place to the other place. So somewhere that $15,000 is going to get recorded.
I see. Because when I sell the house, I'd say the purchase price is $500,000.
Right.
Yeah. But I see what will happen.
You didn't, like when you sold it for $500,000, you didn't actually take the $15,000, but you did.
Gotcha. I see it.
And that's off of the real estate on selling the buyer side.
Right. Okay. Sometimes it just takes talking it out to see it.
Right.
So.
Or not.
It's confusing because it's yourself and yourself.
Right.
So it's like, but I didn't take my 15%,
Every time I see.
But you did because you paid $500,000. You didn't pay $15,000 less.
Right.
So it says.
Every time I see it where a real estate agent just credits their commission for their mother or for their sibling or something, I always wonder, I'm like, is that something is that like getting around the IRS or something? Like, is there something, is there something that the IRS should have seen and didn't? And because usually I find that the IRS always gets their money, right? If there's a tax break, it's the government telling us they want to do something, right? So complying with the law and setting up your accounts and investments to comply with the law and pay less taxes is just complying with the law. But at the end of the day, IRS always gets what they're entitled to, or mostly. So every time I see like a little, I don't want to say loophole, but like
tweak,
a bug in the system, I always wonder. But every time I get to the bottom of it, it's always nope. It's always no. The IRS gets their money.
If you sell your personal house and you're married filing jointly, first $500,000 is not taxable.
Right.
$250 personal.
Yeah.
If it's an investment, you're taxed.
Right. Yeah. That's
And then it's my job to help lower that taxable income by coming up with expenses.
right. The taxes that you paid
So
over
even
time.
though you didn't take that $15,000, so the house got $500,000, but you didn't take the $15,000. But on paper, you probably you did.
Right.
So then on yourself for your business, you deduct the real estate, $15,000.
Got it. And then something that you just said was very, very important. One of the biggest tax breaks in real estate is the residential, the capital gains on a residential real estate. So why don't you tell us what that rule is again?
So if you're single, the first $250,000 of your primary resident, you have had to live in there 3 out of the last 5 years.
3 out of the last 5 years.
You have to have lived there for 3 out of the last 5 years or 2 consecutive years.
2 consecutive years or 3 of the last 5 years.
Yeah.
Okay. So, right. So you buy a house.
So you can live in a house and then you can live in your house for a couple of years and then leave and then go back.
Mm-hmm.
And you can, as long as it's your primary residence.
Right. So like our friends in New Jersey, they keep their house or they buy a house on the shore, move to Florida, and rent it out. Right.
Which one are they renting out? The Jersey?
Jersey. They leave Jersey, keep the house, rent it out.
Okay.
They could do it for first year. They could do it for the second year. But after 2 years, they want to really think about possibly selling that house, because if they don't, they're going to lose that benefit of the capital gains on primary residence, because eventually that will stop being their primary residence.
Right. The house in Florida is their primary resident.
Right. But they
Will
can
become.
the house in Florida for 2 years. The house in Florida is the primary residence, but that house in New Jersey, when they sell it, they will have that benefit if they live there for 3 of the last 5 years. So they can rent it out for about 2 years, but then they have to sell it to capture that capital gain.
Right.
Otherwise, they're going to lose that benefit, and regardless of how much money they're making on the rental, paying the capital gains on a paying capital gains on $500,000 worth of income is a lot of money.
Right.
Do you deal a lot with 1031 exchanges?
I do. I have done some with cost segs and 1031 exchange.
What was the first word you said?
Cost seg.
Cost egg?
No, cost segregation.
Cost segregation.
Yes.
That's different than 1031 exchange?
Yes.
What is cost segregation?
So a 1031 exchange is when you buy a house or a building and you're a real estate investor, not your primary residence. And let's say it's worth $500,000 and you want to sell it and not pay capital gains tax on it. You have to find a property within a certain time period that's either a house of $500,000 or greater. And within, I believe, 90 days. Mm-hmm. And then you sell that house, buy another house. Or it could be a multifamily, or it could be, usually it's multifamily, or like a complex or a commercial property.
To keep it simple, you are selling an investment property and using the proceeds to buy a replacement investment property. And because you're doing that in a certain way called the 1031 exchange, you don't have to pay the income tax on the sale. If you were in the stock market, right, if you were selling your shares of Apple in order to buy shares of Microsoft, you'd pay capital gains tax on the sale of the Apple. But only in real estate can you do this thing called 1031 exchange, where you can buy an investment property, sell it, and hold the proceeds, roll it into the new investment property, and not pay capital gains on the sale, because that money is still invested.
Yes.
Okay.
But in the capital gains, you can't live in it, right?
1031 exchange is for an investment property.
Okay.
It's not for residential real estate.
Okay.
Residential real estate's better because you have that capital gains exclusion that we talked about.
$250.
You mean your personal? You can do a 1031 with like a residential property, but usually it's
you're not living in it.
You're not living in it.
Stacey's question is, you're not living in it.
Yeah.
Right? You're not living in it. It's an investment property.
Gotcha.
If
Yes.
I know somebody who bought a 1031, who did a 1031 exchange and bought a second home for themselves. They don't live in it full time. They may come down every now and again, but they're not going to be living in it for 2 more years.
Do they rent it out?
They don't. And I need to ask him to rent it. I need to ask him if he wants to rent it out. I was just thinking that, because if he did that, he should be.
The rule is
It's an investment property.
the rule is you're selling an investment property and you're replacing it. You're
Right.
buying another investment property. So
They could technically rent it out though if they wanted to.
they should rent it out.
Yeah.
Is there a reason why he would just let it sit there for 2 more years until his kids can go to school down here? Like, that seems kind of like a waste of money.
The reason is he
another-
cheated.
Oh.
He cheated. He did not intend to buy an investment property. He sold an investment property
Right.
and he used the proceeds to buy.
A house that he will eventually live in, which is really not the way 1031 exchanges
That's not
should
what
be
it
Right.
done, but he kind of cheated. Okay, got you. So
cheated.
Unless he bought it for his kids, who, if they go to college down here, rent it from him.
okay.
But they have to
younger,
rent it
but-
from him.
Right.
Got you. That is so interesting. Because I've had a few people, like I had another guy and he wanted to buy a second home. He was going to do the same thing, but he didn't wind up doing it.
Now,
Because that's illegal.
I know.
Now,
right?
what you
I
said
thought it was weird.
What you said before is the property's vacant.
Right.
You should suggest to him that he
To
rents
rent
it out.
Right.
Yes, it's a good realtor, right?
Yes.
You should suggest to him that he rents it out. And if he says no, you might want to remind him that one of the reasons he bought this investment property was to rent it out. And it would not look good that he didn't rent out this investment property.
And I just did a podcast with an accountant, a tax accountant, and I was reminded of this. So that's good.
That is awesome. That is awesome. So if one of my real estate agents, they want to contact you, one of our investors wants to contact you, how do they get a hold of you?
My email address, my business is Green Tax and Business Advisors. And
Green Tax and Business Advisors.
spelled out and. So it's a very long name. But green gives you money. So
Right.
you can't forget green.
Is that how you came up with the name?
No, that's my last name. I'm Jessica Green.
Okay.
But it's very convenient.
Yes, yes. Before we go, I also wanted to say you can do a cost study. So if you buy an investment property and you're going to hold it for a while, usually more than 3 years, and it's better if it's worth more than $500,000, you can take bonus depreciation or accelerated depreciation. And instead of depreciating your full house, let's say over 20 or the commercial property over 39 years, you're able to break it down, but it's a whole engineered study that you have to do. And there are rules and regulations around it, but it really significantly saves money.
And let's say I didn't understand that, but who do I recommend that to? Investors?
Real estate investors who are buying and holding property. So if you're buying and flipping, or if you're doing land, or then that's not. But
if you're going to buy and hold and turn it into a rental or an Airbnb, they need to talk to Jessica about cost segregation.
Yes.
All right. What about the thing where if you buy I remember when the Cadillac Escalades were popular. What about the thing where you buy a Cadillac Escalade and there's special tax deductions for it?
Your car has to be over 8,000 pounds, and then you're able to depreciate 80%.
Mm-hmm.
So it changed this year.
Gotcha. So, does it have to be a truck?
And you really don't want to buy a car every year, but
Does it have to be a truck?
it has to be a certain weight.
It has to be a certain weight.
Yes. So
So-
usually it's a truck.
Right. But if you buy a big Rolls Royce, that's over the same weight.
It has to be a weighted
Yeah.
car. So it has to be a big car.
I know people in
And
town.
real estate professionals do drive a lot. So
Yeah.
that would be a legitimate expense.
That's,
Yeah.
wow.
I mean, it doesn't mean you have to drive a Rolls Royce, but
I've seen people buying big Rolls Royces on using this depreciation method, and it's like, oh, it's a good business car. Yeah, it's usually pickup trucks, but yeah, use your Rolls Royce.
yeah.
So that's awesome. So anyway, if you are a signature real estate agent, Jessica is a preferred vendor. So you can just go on the company's website, the signature contactsarah.com website under the preferred vendors. Jessica's there as a preferred signature vendor. Otherwise, you can reach out to Jessica directly or reach out to me, Stacey, or Jill. We can put you in touch with Jessica. You will save a lot of money. And saving money is as good as making money.
Yeah, thank you.
Yeah, thank you so much. That was so insightful. Really helped me understand a lot.
Thank you very much for having me. Appreciate it.
All
Thank
right.
you.
All right. We'll talk to you again after April 15th.
Yes.
Okay. All right, everybody. This is just a reminder. Go do your taxes.
The future looks bright and the storms pass by. The sky's dark blue and it's almost that time. Light shows, cameras flash when I pass. Living in the moment, forget about the past. They save the best for last. Matthew Mania, we about to make a splash. Life is a marathon full of sharp turns. Gotta keep pace while the hands on the clock turns. High stakes, 5-star real estate. I run a show, you can tell the boss in the place. Electricity, energy, it vibrates. I'm always on time even if I'm late. I make dreams come true, living my life, hope the same for you. Success in my sights, got a real clear view. If you don't know the time, I'll give you a clue.
You know what time, you know what time, you know what time it is. Yeah. You know what time, you know what time, you know what time it is. You know what time, you know what time, you know what time it is. You know what time, you know what time, you know what time it is.
You know what time it is. You know whose time it is. You know what time it is. Matthew Mania, the time is his. You know what time it is. You know whose time it is. You know what time it is. Matthew Mania, the time is his. Yeah, got him shook, scared, can't look. We're not afraid of